6 companies today, all significance 4 or 5. Heavy on strategic pivots, M&A, and some genuinely alarming balance sheet moves. Let's go.
Yeah, there's a lot to unpack. A few real red flags buried in here.
Starting with ticker 2934, the big news is they finally removed the going concern uncertainty. That's huge, but they're not out of the woods.
Right. They swung to a net loss of 321 million yen on 516 million in extraordinary losses, mostly goodwill amortization from aggressive M&A, fully acquiring Well Venus and buying at Shake Hands with a 1 billion yen Mizuho loan.
And they're breaching financial covenants now? DE and net asset ratios?
Yes, but Mizuho granted forbearance. The B2B healthcare marketing segment is growing nicely, EBITDA up 112%. So there's a real business emerging. But that debt load is a watch item.
Ticker 6047. This one's fascinating. They dropped from prime to standard market, declared an AI native transformation, and the KDDI partnership ends in 2027.
And they're essentially extracting cash from their profitable subsidiary Game 8 to fund everything. Game 8's net assets dropped over 50% from dividend payouts to the parent. That funded a massive buyback and a special dividend from their Indian fintech investment turning profitable.
So they're milking the cash cow to bet on gaming and AI. Bold or desperate?
The G Holdings gaming acquisition is still loss-making. I'd say ambitious, but the execution risk is real.
Ticker 2791 is the most concerning of the batch. Revenue crossed 300 billion yen, but operating profit fell 46% and they more than quintupled long-term debt to 21.5 billion.
And they still did a 3 billion yen share buyback. Equity ratio dropped from 52 to 44%. The founder also passed away, which adds succession uncertainty.
Growing into a trillion yen vision by 2035, but funding it with leverage while profits halve? That's aggressive for a discount retailer.
The SFO store format shift, 7 of 25 new stores, is smart for capital efficiency, but the SG&A, surge from labor and logistics, is eating them alive right now.
Ticker 4885. Clean story here. Exited the health food business, new midterm plan 2031 with aggressive targets, and they're targeting AI data center demand in chemicals.
Operating profits surged 72%, but net income fell 32% due to a 398 million yen impairment in pharma synthesis. They also shifted to semi-annual dividends and brought in a former Nomura exec as outside director.
The AI data center angle on functional adhesives. Is that material?
Still early, but the Chemical Development Center investment of 350 million yen signals they're serious. Clean balance sheet too, nearly 2 billion in cash.
Ticker 9216. First overseas acquisition. 85% of a Malaysian company called Radiant Communication. That's a meaningful strategic step.
They're fusing Radiant's generative AI agent with their domestic Omnia Link platform. Profit recovered 28% despite flat sales, driven by cost cuts. They reduced operation booths and consolidated locations.
Client concentration risk also improved. TEPCO down to 14%, Persona under 5.
The chairman is retiring too. Leadership transition plus international expansion. Execution risk, but the AI pivot looks credible.
Last one, ticker 7487. They raised midterm operating profit targets from 300 million to 550 million. That's a big jump.
They fully divested Asfit, exited household paper, and repurposed the Saitama Logistics Center for non-woven fabrics. Net income rose 49%, also adopted a cumulative dividend policy, and scrapped seniority for a role-based grade system.
Cleanest story of the 6. Strong cash position, focused portfolio, and the clean room AI data center exposure is a real growth lever.
Common thread today, everyone's chasing AI data center demand, and half these companies are restructuring aggressively to get there. Watch the leverage stories, 2791 and 2934 especially.
Agreed. And the ones extracting cash from subsidiaries to fund pivots. That's a pattern worth monitoring across small-cap Japan.